As a result of the multiple factors that influence the stock market, predicting the stock market has always been a very difficult task. From a company's performance to economic indicators to investor sentiment and all other global events, all of these factors play a role. In the stock market, the stakes are extremely high since accurate predictions can result in significant financial gains, whereas errors can result in tremendous losses. In order to make informed decisions, both investors and traders use different forecasting methods. Introducing machine learning into the financial market has caused a great shift. With machine learning, you can make more accurate predictions because it can process and analyze very large amounts of data. Our machine learning model can identify patterns and trends from historical data that are not immediately apparent to humans. Deep learning algorithms, such as CNNs, convolutional neural networks, are one of the most important applications of machine learning. They are specifically designed to process and analyze image data, which makes them ideal for interpreting graphical representations like candlestick charts, which are commonly used in financial markets. Candlestick charts provide a visual representation of stock price movement over time in financial markets. These CNNs can be used to analyze these charts and detect price patterns that can help predict future market behavior. According to the efficient market hypothesis, stock prices fully reflect all available information, making it nearly impossible for investors to consistently achieve higher returns than the market through stock selection or market timing. Because of this, any new information is quickly incorporated into stock price, and so any attempt to forecast stock movement is flawed unless it is based on information not yet available to all traders. It creates a very significant challenge for those who attempt to forecast stock price, and suggests that higher returns can only be accomplished by taking additional risks. Stock market predictions have been made using various methods over the years. A neural network, specifically the backpropagation method, was used in earlier approaches. The technique, which dates back to the 1990s, involves adjusting the weights of a neural network's connections to minimize prediction errors. With the rise of social media, new sources of data have emerged for stock market predictions. Public sentiment about stocks and the market can be gauged through sentiment analysis, which analyzes tone and content of social media posts. Studies have shown that social media sentiment can provide valuable insights into market behavior, such as one that analyzed Twitter data to predict Dow Jones Industrial Average movements. In addition to its advantages, sentiment analysis presents challenges, including the need to remove noise and irrelevant information from large volumes of information. In technical analysis, candlestick charts provide a visual representation of price movements over a specified period. Several key pieces of information are displayed on each candlestick on the chart: the opening price, closing price, high price, and low price. When the stock closed higher or lower than it opened, the candlestick's body is filled or hollow, while the shadows are the highs and lows. Candlestick charts have historically been used by traders to identify trends and patterns. The hammer, doji, and engulfing patterns are believed to predict future price movements. Some candlestick patterns can be statistically significant indicators of future price direction. The Brazilian stock market was analyzed using 16 different candlestick patterns, while another used wavelet-based textures to improve prediction accuracy. Machine learning models have incorporated candlestick charts into their predictive capabilities in recent years. For example, one approach involved using a convolutional encoder to learn the patterns within candlestick charts, and subsequently using this knowledge to make stock market investments. A different study compared artificial neural networks, ANNs, support vector machines, SVMs, random forests, and naive Bayes classifiers using candlestick chart data for input. Candlestick chart data has been successfully analyzed using traditional machine learning algorithms, such as random forest. Researchers have been able to achieve good predictive performance by combining these algorithms with technical indicators. Furthermore, some studies have explored the use of external data sources, such as financial news and social media sentiment, in conjunction with candlestick chart analysis. A study of the Taiwan and Indonesian stock markets is conducted using historical data from 50 Taiwanese companies and 10 Indonesian companies. Their growth and prominence within their respective markets led to their selection. There are three types of historical data: training, testing, and independent. Training data spans January 1, 2000 to December 31, 2016, while testing data spans January 1, 2017, to June 14, 2018. Test data and independent data are used for further validation. An API from Yahoo Finance provided comprehensive historical time series data, including daily open, close, high, and low prices, and trading volume. In order to make accurate predictions, it is imperative to use well-segmented and historical data, which ensures that the models are trained on a variety of market conditions. Several machine learning models, both modern and traditional, were used to analyze and predict stock market movements using candlestick charts. Convolutional neural networks, CNNs, were the primary focus, but other models were also compared, including residual networks, ResNet, VGG networks, random forest, and k-nearest neighbors. In deep learning, CNNs are particularly effective at handling image-based data. Convolutional, pooling, and fully connected layers work together to extract features from input images. Input images are filtered using convolutional layers, which capture edges, textures, and shapes. By pooling layers, the data becomes less dimensional, making the network more efficient. The CNN architecture consisted of 4 convolutional layers followed by ReLU activation functions and max pooling layers. To prevent overfitting, dropout layers were added to set a fraction of the input units to 0. As the final layer of the network, the dense, fully connected layer predicted whether the stock price would rise or fall. Residual networks, ResNet uses shortcuts or skip connections to jump over certain layers. It mitigates the vanishing gradient problem, where gradients used to train networks become too small, slowing down learning. When deep networks are required to capture complex patterns in data, ResNet is particularly useful.